Good morning. Thank you so much for joining us for today's Revenue Recognition Disclosures webinar. We do have two handouts that are available for you. We have one that's a reference and one that is a PDF of the slides, so you can click on those and save them to your computer. To earn CPE today, there will be 4 polling questions. When they pop up on your screen, please be sure to select an answer. And if you answer all of the polling questions, you will receive a CPE certificate via email in about 2 to 3 weeks. If you have any questions for our instructor today, you can type them into the questions box and we will get to them throughout the webinar. That is all for me, and I'll turn it over to you, Michael.
Thank you very much, and thank you everyone for attending today's webinar. This webinar is one webinar within a series that we've been doing over the past few years related to 606, and we hope to do a number of other these presentations related to 606 before its ultimate adoption and audit for private entities sometime in the spring of 2020. With that said, today we're going to talk mostly about revenue recognition disclosures, what are those requirements, and some nuances that you need to think about. My name is Michael Hoos. I am a CPA. I am a senior manager in the Raleigh office and part of the professional practice department. I spend about half my time serving clients, mostly in the SEC and tech and life science industries, and the other half of my time manning our firm's resource desk and answering questions and developing content in lessons such as today's webinar. I know everyone wants to make sure we get our CPE, and I want you to get your CPE, so please answer the poll question, which is, what industry are you in? Give everyone a couple seconds here to do that. Looks like we've got, 65% are in something outside of one of the listed industries there, and that's not too surprising. That is definitely expected. I'm sure a lot are in non-for-profit or government, that kind of thing. So again, today we're going to talk about, what are the requirements of 606 and the disclosures, and what are the differences between public and private entities, and what are the different requirements. And we're going to go over some examples of different ways of presenting the requirements, and then we're going to talk a little bit about some new processes, controls, and internal reporting that might need to get done in order to meet these disclosure requirements. In your handouts pod, there is a brochure that I'm essentially going to use as kind of the roadmap to today's presentation, and it's a 2-page front and back brochure that kind of looks like this, and if you want, you can open it up as we go along in this presentation. The heart of it, though, is the last page, or the front and back of the last page, and that is what are the different disclosure requirements and the different categories of them, as you can see in the leftmost column. And then what are the requirements for public companies in the middle column, and then non-public companies in the right column. And we're literally just going to go through each of these and talk about, elaborate and talk about some of the details and that kind of thing. So I would go ahead and recommend that you open up that and follow along. And so the first thing we're going to talk about is the requirements. And the overall requirement is to meet this objective, which is to enable users of the financial statements to understand the nature, amount, timing, and uncertainty of revenue and cash flows, and to prevent qualitative and quantitative information about that type of stuff. And so one of the questions I get often is, well, are there certain disclosures that I can omit? And the answer is absolutely there are certain disclosures you can omit, and we're going to talk about some of the exceptions that are, available for private entities. But as always, you can omit a disclosure if it's not applicable to your entity, or if it's immaterial, and I call that the immaterial omission. It is technically applicable, but it's a small dollar amount, or qualitatively small. You can omit that, and the argument that you make to your auditors is, hey, this is an immaterial omission, and we don't need to disclose that. So let's talk about that first category. Again, this is straight from the brochure that is part of your handouts. The first category of required disclosures is disaggregation of revenue. And as you can see, public companies and non-public companies have two different requirements. So public companies are required to disaggregate into many different possible categories that would appropriately meet the objective that we showed in the previous slide, which is to, describe the nature, amount, and timing and uncertainties of revenues and cash flows. And there are certain considerations that we'll go over in the next slide to kind of talk about how that might be, what might be the levels of disaggregation. And then the last row of this slide here, that's really the biggest difference between public and non-public companies, is that public companies have to disclose and reconcile between this disclosure of disaggregated revenue and the segment disclosure. And so moving on to the right side of the screen, non-public companies, all they're required to do is disaggregate revenue between those contracts that are recognized at a point in time and those that are recognized over time. And then they can just provide qualitative information about other factors that might affect the nature, amount, and timing and uncertainties of revenue and cash flows. And they are not required to present more disaggregation like public companies are, and they're not required to reconcile that disaggregation to the segment footnote. So, with that being said, must all auditors of all entities consider the level of disaggregation that is sufficient to meet 606, meaning even though I'm a private entity, is my auditor still going to analyze and determine whether I've presented a sufficient disaggregation? Yes. So even though I'm a private entity and the minimum requirement is that I present and disaggregate between those contracts that are recognized at a point in time and those contracts that are recognized over time, that's the minimum, I still am required to meet the overall reporting objectives, which is to properly present the nature, amount, and timing and risk associated with revenue and cash flows. I still have to do that and meet that objective. So I still might have to, in order to meet that objective, present something above the bare minimum that is required for private entities, which is just the overtime revenue and point-in-time revenue. And so, whether I'm a private entity or a public entity, if I'm going to present new disclosure information, including disaggregated revenue, am I required to test the reliance of those reports? As an auditor, I am. So now that you're going to have additional disclosures to make over 606, your auditors are more than likely going to come to you and say, okay, this is a new report that we are relying on to either support the financial statement disclosures if you prepare them, or if the auditors prepare the financial statements, the auditors will be using that report to draft that disclosure. And so that report can't just be taken at face value from an audit perspective. It has to be tested. And so that might, you get some more additional questions about how you know that report is accurate, especially relevant for disaggregation. How do you know that, maybe in total it agrees to total revenue, but how do I know the different buckets are correct? So there's multiple levels of disaggregation. The very first and highest level is separating all total revenue between those contracts that are within 606 and all other revenue. And that's something that I wanted to kind of point out because it might not be, evident just by reading through the standard that that is might be one of the trickiest things, because, for example, if you are a financial institution and you have interest income, what if you're a leasing company and you have lease income that would be under the 840 or 832, the new lease standard, but you also have certain revenues that are guided by 606. You are now required, both public and private entities have to disaggregate revenue between those that are guided by 606 and those that are not. And so that's the first level of disaggregation, and that's applicable to all entities, public and private. And then the next level is more open to judgment and what the entity believes is necessary in order to meet the reporting objective that I mentioned in the first slide. And so here's the different categories that are mentioned, the type of good, perhaps like by major product line, that kind of thing. The geographical region, it could be country, it could be, areas within a country, that kind of thing. Market or type of customer, for example, government versus non-government customers, large versus small customers, cash versus credit. Again, you want to be thinking about, what does the users of the financial statements, what do they need to know? What level of disaggregation is necessary for them to be able to understand the nature, timing, amount, and risk related to both revenue and the cash collection of that revenue. The contract duration, it could be, for example, short-term, long-term contracts. The one that's underlined there in the second column of the middle row, timing of transfer of goods or services. So that one's underlined because that's required for both public and private entities. So all these different boxes and different ways of disaggregating might be applicable to a private entity if they feel they need to do that in order to meet the reporting objective. But the bare minimum is the one that's underlined, which is that you are required to disaggregate between revenue that's recognized at a point in time and revenue that's recognized over time. So those of you who are hopefully familiar with 606 know that in step 5 of 606, you determine whether or not you recognize revenue at a point in time or over time. And that's important, obviously, to meet the step 5 requirements, but also in determining what type of minimum level of disclosure, even for private entities, is required. And then the other things that you want to kind of think about are how is revenue disaggregated outside of the financial statement. So if I'm a public entity or even a non-public entity, and I have earnings releases or annual reports or investor presentations, if I have communications outside of the entity that disaggregate a certain way, then there's almost a rebuttable presumption that you would also, in the footnotes, disclose at that level of disaggregation. I would make sure that I have my I's dotted and T's crossed if I would not do that. I would make sure I have a good reason why I felt like it was not necessary to put it in the footnotes. And then also, if there's a chief operating officer and they are evaluating financial performance at different levels of disaggregation, that might also be the level of disaggregation that should be presented in the financial statements. So I learn best sometimes by just being able to visualize things. So let's kind of take a look and see what that would look like. And so this is a example, a pretty good one, of what disaggregated revenue would look like. And it's in tabular format here. And I want to note that for private entities, the only requirement would be this very box, the very last things at the bottom here that are boxed in orange. And that is the separating, disaggregating between revenue that's recognized at a point in time versus over time, and you just have to present that in total. There's no reconciliation to the different segments. As you see on the screen, the segments are horizontal at the top, and then the vertical disaggregations are the disaggregations for 606 purposes, and so they're reconciling to the segment disclosures. And so that only what's boxed in is what's required for private entities. And so if you're a public entity or even a private entity, some of these things would apply, which is, your auditor is going to first think, okay, does my total revenue for whether it's disaggregating by geographic markets or major goods or services, or in the case of private entities, a timing of revenue, does that reconcile to my segment footnote? That's the first thing they're probably going to ask themselves, and that's probably pretty obvious and easy. One of the questions that your auditors might ask is, should we have more or less disaggregation? Not just what's on the screen, what is being presented by management, but also, should there be more disaggregation out here? Or is the level of disaggregation obfuscating something? Is there, should it be at a higher level so it can work both ways? Is this information currently available? And that's an important question, I think, for this audience is, if I'm a private entity, do I currently, ask yourself, do you currently have the ability to disaggregate revenue between a point in time and over time and have an accurate report that your auditors can rely on that would show that? Or if you're a public entity, do I have info that, once I decide what level of disaggregation is required to meet the objective, do I have reporting that I can rely on that presents that level of disaggregation? And then, of course, any reporting that is used internally and any reporting that the auditor is going to use either to prepare the financial statements for private entities or to audit the financial statements for public entities, they're going to want to be able to test the reliance of that report. So you're going to have to make sure that that report is either a canned report or it has a proper, control surrounding it so that it can be relied upon by the auditors and yourself. And so here's another example, and this is more keen to a private entity. So again, a private entity is only required to disclose the point in time versus over time in total, and does not require to reconcile to the segments as it's done here. But in order to meet that objective of understanding the differences in the nature, timing, amount, risk, and uncertainties of revenue and cash flows, the private entities are also required to give some qualitative instead of quantitative information. So in this particular example, the qualitative information would be, hey, consumer products are sold to retail resellers, and generally sales are collected within 2 months. So, they're saying, hey, here's how we recognize revenue, and here's how we collect cash for this particular type of segment or product types. And then they also go on to qualitatively describe, here's the differences between revenue and cash. For consumer products, it's collections within 2 months. It's assumed that revenue would be recognized at point of sale. And, for transportation and solar panels, revenue and cash flows are generally recognized concurrently. So that's another way that the qualitative requirements that are required for private entities could be presented. And then lastly, the type of customer. They talk about the different types, like the retail, resellers, and the third-party type of contract. So as you can kind of see there, going back to the brochure, you have to present disaggregated revenue for your private entity between over time and point in time. And if you're a public entity, there's probably many more ways you have to present that disaggregated revenue. And if you're a private entity, you still have to present qualitatively the differences in how that timing and amount would be impacted by the type of customers and contracts and that kind of thing. So let's move on to the next part of the brochure, which deals with the reconciliation of contract balances. And the first one we're going to talk about is the one that is required for both public companies and non-public companies, and that is the opening and closing balances. So I think that now's a good time to have another poll question. Is your entity public or is your entity private? Give everyone a few minutes to make sure that we answer those poll questions and everyone gets their CPE. All right. It looks like most people have had a chance to respond, and it looks like we've got about 80-20, the Pareto principle, 80-20. We have 80% roughly that are private, and 20% that are public entities. So that's a good mix, and about the mix that I would expect. So there's definitely folks on that need to know what the public requirements are, and also we got a lot of private companies that we're going to probably focus more on than just the public. So let's go to another FAQ related to disclosures, and that is, if an entity discloses information in accordance with another codification topic, say in another footnote, must it also disclose the same information in the revenue footnote, the ASC 606 footnote? And the answer is no. You only have to present it once within the financial statements. Now, I think it's important to know for those public companies out there that that means the financial statements themselves, the balance sheet and income statement, equity statement, cash flow, or the footnotes, but you can't rely on something that's presented outside of the financial statements, and technically the MD&A and other things that are perhaps in the annual report are technically outside of the financial statements, even though we kind of think of them as part of the financial statement. So if it's within the actual financial statements themselves or the footnotes, in another footnote, say your inventory footnote or your accounts receivable footnote, that's okay, that's fine. But if it's outside of those and some sort of other reporting of part of the 10K, then no, that it does need to be, redundancy that needs to be there. There needs to be in the actual footnotes, because that's what the auditors are opining on. This is a pretty cool FAQ, because I think a lot of folks haven't kind of thought about this yet, but contract asset and accounts receivable be used interchangeably? And the answer to that is no. There is a difference between what a contract asset is and what an account receivable is. So the difference being, a contract asset is not contractually, you're not contractually able to bill for it. Whereas an account receivable is something that you are contractually allowed to bill for, you've billed, and only the passage of time is going to dictate when payment is received. So it could be, for example, that the best example I would give with this is variable consideration. If I have a contract that has a significant amount of variable consideration, and that variable consideration isn't determined until the end of the contract, well, under 606, as many of you hopefully know, I'm required now to estimate that variable consideration and allocate it to all the different performance obligations. Well, when I satisfy a performance obligation, I would recognize revenue, some of which would be the allocation of that variable revenue. And so obviously I can't bill for it yet, so it would create a contract asset, not a contract, an account receivable. So that would be a really good way of kind of just distinguishing between a contract asset versus a receivable. Here's another one that I think has gone under the radar for many folks, and that is, if a contract has both an asset and a liability, must an entity net the two at the contract level, or can asset and liabilities be summed with other contract and assets and liabilities from other contracts? And so, let me give you an example again here. We'll go back to the variable consideration. I might have accounts receivable for this variable consideration that I'm expecting to receive at the end of the contract. I might have a contract asset for that. And I also might have certain upfront fixed payments that I receive, and I have not yet satisfied those performance obligations. So I might have satisfied some performance obligations that have some variable consideration that are being allocated to it, and so I have to have a contract asset. But then I have other performance obligations that maybe are prepaid, wholly fixed payments, and I haven't yet performed on those performance obligations. Those might be deferred revenue, a contract liability. And so what the standard requires is that I have to net it at the contract level. I'm not allowed to net it as an entity as a whole. So you have to ask yourself, does my current reporting ability, do I have an ability to go by a contract by contract, what are all the contract assets and accounts receivable and contract liabilities and deferred revenue? What are they on a contract level? And that has to be netted. They can't be grouped up with other assets and liabilities from other contracts. And so that's something I think that a lot of companies currently don't have that reporting ability. All right, so let's keep moving on with reconciliation of contract balances here. One of the new requirements for public companies, and it's just a recommendation, it's not a requirement for non-public companies, is revenue recognized during the period that was included in contract liability balance at the beginning of the period. So think of this as like your deferred revenue, if you will, right? So it might be that I had collected revenue, prepayment from a customer for a performance obligation that I have yet to satisfy. So I have deferred revenue at the end of 1 year, and I am now going to be required to disclose at the end of the following year how much of that deferred revenue I recognized during the period. And so ask yourself, do I currently have the ability to do this with my reporting, current reporting abilities? And if you don't, then that's something that you need to start preparing for now, obviously before implementation, because it will be a required disclosure for public entities. So hopefully you've already done that in Q1 or Q2. And then the next required disclosure is going to be revenue recognized during the reporting period from performance obligations that are satisfied in previous periods. And this is one I think that we need to kind of like break down a little bit. Again, this one's only required for public companies. It's recommended for non-public companies. And again, if you feel like that it's necessary to meet the reporting objective, then it would be required. So the reporting objective is kind of an umbrella over all these things. And if you feel like even though it's not technically required for non-public entities, if you need to do something in order to meet that objective, then it would be required even though it's not explicitly required. It would be required indirectly through the overall reporting objective. But speaking directly about this particular requirement, and that is, what do you mean, Michael, by revenue recognized during the reporting period from performance obligations satisfied in previous periods? How does that make sense? How do I recognize revenue in one period, but I satisfied that performance obligation in a previous period? That doesn't make sense. Shouldn't I recognize the revenue, all of it, in the previous period? And so the most common example of this is changes in variable consideration estimate. So, if I estimate that I'm going to collect, $1 million in variable revenue, and I allocate that revenue to the different performance obligations, I might satisfy a performance obligation in 1 year, and then in the next year, I have to adjust my variable consideration estimate because I think I'm either going to, do better or do worse. And so that's when revenue would be recognized in the current period potentially. If I'm increasing my estimate of variable consideration in the current year, and I have to allocate that estimate change to the various performance obligations, it could be to a performance obligation that I satisfied in a previous year. And so that's what this means, what this requirement means. So I think a good example would be warranted here, and that is Entity A enters into a construction contract for a $150,000 fixed fee plus a bonus of $60,000 if Entity A completes the project before 24 months. Okay? As of December 31st, 2018, Entity A estimates it is 33% complete and believes that it will not receive the bonus. So, Entity A recognizes revenue of $60,000, okay, which is, the 33% of the 150. and they don't recognize any contract asset or liability. A year later, as of December 31st, 2019, Entity A estimates that it's 80% complete and that it will receive the bonus. Thus, Entity A recognizes revenue of $168,000, which is the 80% complete that is now done. It's going to be recognizing revenue of $168,000 in as of December 31st, 2019. And the question is, what, if any, disclosure is required under ASC 606? Under 606, if I was a public entity, I'd be required to disclose that $20,000 in revenue was recognized in 2019 from performance obligations that were satisfied in prior periods. Okay, and so that's the delta between the amount of variable consideration that I now believe I'm going to get that was, for performance obligations, the 33% that was complete as of the previous year. So 33% of $60,000, or 1/3 of $60,000, the variable consideration, that is $20,000. And so that's the amount of revenue that I would have to recognize or disclose that I recognize in the current period that are actually related to performance obligations I had satisfied in prior periods. Here's another really good example that really hits home, I think, for a lot of tech and life science companies that are on the line. So in 2018, Entity A licenses a drug patent to Big Pharma in exchange for $1 million upfront fee plus 5% of Big Pharma's sales of patented product. In 2019, the next year, Big Pharma sold $5 million of the patented product, and so they paid Entity A $250,000 in royalties. What, if any, disclosure is required under 606, again, for public entities? The entity should disclose that $250,000 in revenue was recognized in 2019 from performance obligations that were satisfied in previous periods. So for those who might not know, and hopefully many of you do, if I am licensing a license of intellectual property, in this case a drug patent, that's one of the few exclusions from having to recognize variable consideration. I am prohibited from recognizing sales or usage-based fees that are based upon a license of intellectual property. I have to recognize that revenue like we would under legacy GAAP when the actual contingency is resolved and that sales or usage occurs in the future period. So in this case, I fulfilled my performance obligation by handing you the license in 2018, and I only got $1 million fixed fee, but I couldn't recognize any revenue in 2019, or I couldn't, recognize any revenue in 2018 when I sold you the license because I'm prohibited from recognizing variable consideration until that sales or usage occurs, because this is a license of IP. And so in 2019, when that actual sales or usage occurred, I got $250,000 in royalties. So now I'm recognizing revenue in 2019, but technically I fulfilled my performance obligation in 2018, and so I'm required to disclose that. And that's another really good example, I think, of what that disclosure requirement really means. And then another thing that we're supposed to disclose is, if you're a public entity, is qualitative and quantitative information about significant changes in account balances, okay? So there's a plethora of things that could change account balances. And so I put together a list here of the most common things that would change an account balance. So, satisfaction with performance obligation, right? So if I had a satisfaction of a performance obligation, I'm probably going to be creating a contract asset, right? Because I have earned the revenue. I might not be entitled to bill it, so it might not technically be a receivable yet, but I have a contract asset. I've earned this. And then the next box is conversion of contract assets to receivables. I might, have fulfilled the contract in one period, and now it is allowed to be billed in the current period, and it is still outstanding as of year end. So I now have a contract, a receivable that once was a contract asset. Obviously, collections of receivables, right? So if I, collect a receivable, it goes away. That would be one change in a contract asset or liability. A prepayment. If a customer prepays me, I probably have a deferred revenue, a contract liability. Commissions. That's one of the things that I think slips a lot of people's mind about the new revenue standard, which is the new revenue standard changes not just the revenue standards in Crate 606, it also changes ASC 340, which is dealing with contract or dealing with other assets. And so commissions now are going to be required to be capitalized under 606 in many situations. And so now commissions, if I pay commissions, that could be a change in contract asset liability or receivables that needs to be disclosed if I am a public entity. Business combinations, that's another one I think that slips people's mind. If I buy another company, they're going to have their own contract assets and liabilities I need to bring on the books. So I probably need to show how the business combination contributed to the net change in my contract assets and liabilities. Changes in the estimated transaction price, that's the rightmost box on the middle row. That, again, we've talked several examples about how variable consideration can change from one period to the next, and it might relate to performance obligations that were previously satisfied, or might be related to performance obligations that were satisfied in the current period or will be in the future period. Those changes in transaction price, that will also impact your contract assets and liabilities, as will contract modifications and, of course, impairment. If there's an impairment, for example, say collectability of receivables would be a very good example of one. So, how might this look? And so here's a pretty good example of how that might look. And so, again, I want to kind of differentiate between, what's required for private entities and what's required for public entities. And so private entities are only required to disclose the actual beginning and ending balances of contract assets and liabilities. So you see here, they got the receivables, the unbilled receivables, and then the advances and deposits, okay? And so they're disclosing that, and they have some wording up top that talks about, what creates these contract assets and liabilities. But if I was a public entity, I would be required to also disclose more information, such as, in this case, revenue recognized for the years 2018 and 2017 that was included in my contract liability balance at the beginning of the year. So again, this is only required for public entities, but it's essentially saying, hey, I had a contract liability, say deferred revenue, in the prior year, and here's how much revenue in the current period I recognize related to that. So that's, again, something that's only required for explicitly required for public entities. Now, you also might want to show a reconciliation in tabular format of here's all the different changes, okay? And so here's how this would look. And this comes from the exposure draft and one of the different iterations that came out a number of years ago. And this is probably the best way of doing it, in my opinion, in a tabular format, which is you have your contract assets and liabilities, and you have your net contract asset or liability. And then you have to describe how the revenue was recognized during the period. There was $18,500 in revenue recognized during the period. $18,000 of that related to performance obligations that were satisfied during the reporting period, and $500 related to performance obligations satisfied in a previous period. For example, change in variable consideration, perhaps. Here's how much I recognized as receivables. Here's how much paid in cash, and here's how much was collected in advance, okay? And then you talk about your business combination. Again, that's one that might not be apparent to a lot of folks. And you come up with, okay, the net contract asset or liability should be $100 after you add these up, and you can see at the bottom the reconciliation between your contract assets and liabilities, it nets to $100. And so that might be a way in how you present in a tabular quantitative format a roll forward of contract assets and liabilities, which again is only required for public entities, not private entities, unless private entities feel they need to do that in order to meet the reporting objective, overall objective of 606. So let's move on to the next category of disclosures, and that is performance obligations. All right, so public entities are required to disclose information about the entity's performance obligations, including the nature of the goods and services, when the entity typically satisfies those performance obligations. There's a lot of different information, and so I try to simplify it and say, look, what do you sell? When do you recognize revenue? When and how do you get paid? And then, are there any future commitments? Do I have returns out there, potentially refunds, warranties, that kind of thing? Is there anything else? And again, if you think about the overall reporting objective of 606, it makes a lot of sense that they have it this way. So some of the things to think about when you're, and I do want to go back and mention one thing here. These are all required for both public and non-public entities. So this is one of the categories that there is quite a lot of requirement for non-public entities as well. So what are some of the things that I need to think about that maybe potentially need to be disclosed? And I created a list here. You won't have to go over all of them, but does the entity satisfy performance obligations upon shipment, delivery, or as services are rendered? Bill and hold arrangements, I definitely that would mention that. The very bottom arrow at the left side, significant financing components. Of course, you want to present that. On the right side, the second to the last bullet, agent or principal. And then the last one, material rights. That's something that has been introduced to a lot of industries, is this idea of a material right, a discount for future services and stuff. You need to disclose that because that's a future potential obligation of the entity. So let's take some real-world examples of how this is being done. So this is a large accelerated filer, Big Four audited, got this straight from their most recent 10Q. And so let's go through and see how they do with the requirements. What do you sell? Well, they sell installation and complementary building products. This is Installed Building Products, Inc. When is revenue recognized? Well, we recognize revenue using percentage completion method, and we do it in a cost-to-cost input approach. Okay. Well, when and how do you get paid? Billing on our long-term contracts occurs primarily on a monthly basis. Yada yada. It goes on to describe how they get paid, and then are there any future commitments? And they go on, and I like this here because they are disclosing something that they think is insignificant, but they're still disclosing it. They say an insignificant portion of our sales, primarily retail sales, is accounted for on a point-in-time basis, and there is an adjustment for returns. And then they go on in the second sentence here and say, look, we don't offer, we do offer assurance-type warranties, which, for those of you who know, assurance-type warranties are kind of, I'm not selling you a lemon basic type warranties, and those are not a separate performance obligation. And they go on to say, and services that do not represent a separate performance obligation and thus do not impact the extent and timing of revenue. So they go on to disclose that not only what they do have, but also what they don't have. And we don't have service type warranties. We only have assurance type warranties. So let's move on to the next subcategory under performance obligations. And in this category is a little bit different because it's only required for public companies and not explicitly required for non-public companies. Again, only if you need to meet the overall reporting objective would a non-public company be required to do it. And that is an allocation of transaction price to the remaining performance obligations and the timing of when those performance obligations will be recognized. Okay. So before we get into that, let's have another poll question. Again, I know everyone wants to make sure that we get our CPE, and so this poll question is how prepared do you think your entity is? We're not prepared at all for 606. We are somewhat prepared, or I'm confident we got this. And gives people a few minutes, a few seconds to enter in here. I'm seeing about 70% are saying they're somewhat prepared. And so, that's a really wide range. When you say somewhat prepared, it could be that we've thought about it, or it could be that we, have drafted GAAP memos, that kind of thing. And I'm encouraged to see that, roughly 15% say that they got it, and unfortunately 15% are not prepared at all, and hopefully this presentation and other ways we can help you get prepared. So let's move on. Let's close the poll. And future performance obligation exception. So what the requirement for public entities is that if I have a contract and even if I haven't collected any cash on this contract yet, or I haven't recognized any revenue, I have a signed contract, we've maybe completed part of it, and there's still part of it open to be completed next year and the year following or whatnot, I'm required now to disclose what those remaining performance obligations are. I still have to provide maintenance for my software clients, and I'm expected to recognize $1 million of revenue over the next 2 years related to that. That's what I mean by this future performance obligation disclosure. And there's certain exceptions. That's a very onerous disclosure requirement. So they've made certain exceptions, and the biggest one being private entities are excluded. The next one being if the contract is less than a year, then I don't have to disclose that future performance obligation. So if I feel like I've got some revenue that I still need to recognize, some performance obligations I still have to complete next year for this contract, but the year after that I'm done. I'm no longer going to be using this contract, then I wouldn't have to disclose that. So if it only extends beyond the next year. Sales or usage-based fees and licenses of IP, I don't have to disclose those future revenue that might be recognized related to that. If I use the as invoice practical expedient, meaning the as invoice practical expedient is the expedient that basically says I can recognize revenue as I bill if certain criteria are met, namely being that the value the customer gets corresponds directly with what I'm invoicing. And so if I do that, then I don't have to have this future performance obligation presentation. And then variable consideration allocated entirely to a future performance obligation. So if I have variable consideration in a contract, normally I allocate that to the different performance obligations, on a relative standalone basis. But sometimes I might allocate that directly to one particular performance obligation that's in the future. In those situations, I would not have to disclose what that amount is and when I expect to recognize that. It would be excluded from this future performance obligation category. And again, I think examples are kind of the best way of understanding this. So let's go through an example. On April 1st, 2018, a SaaS company sells a 3-year subscription for $240,000. As of 12/31/18, the end of that year, the entity has fulfilled 9 months of the contract and has recognized $60,000. So that means we have a 3-year contract, so it's going to go into 2019, 2020, 2021. And as of the end of the year, 12/31/18, the end of this year, if I'm a public entity, what, if any, backlog disclosure is required? And so I would be required to disclose that there's $180,000 allocated to future performance obligations. So this is revenue that maybe I haven't even collected it yet, right? Obviously, I haven't recognized it yet, but maybe I haven't even collected it yet. I still have to disclose that the $180,000 is allocated to future performance obligations and how I expect to recognize that. In this case, 27 months. Now, I think it's important now to say, what if I changed it up and said that the company simply signed a 3-year subscription agreement, and at the end of the year, 12/31/18, they haven't done anything yet, right? What, if any, backlog disclosure is required under 606? None. So again, the future performance obligation disclosure is called the backlog disclosure. And so for 606 purposes, the backlog disclosure doesn't apply to contracts that are not enforceable. And right now, because no party has performed, they've simply just signed a contract, then it's not enforceable. It would not be something that would technically be a contract yet under 606. But that backlog disclosure, as it's being called for 606, is not the same as the backlog disclosure that we are required to do for under SEC rules. So a backlog disclosure under SEC rules would include contracts that have just been signed that are wholly unperformed yet. So that would be kind of the difference between. And of course, that leads me to the FAQ of, is the definition of a backlog under SEC guidance the same as it is under 606? No. Let's go through another remaining performance obligation example, because again, I think this is one that deserves a little bit more discussion. And that is, as you see here, they talk about the different deferred revenues that they have, and they say here in highlighted green, as of May 31st, 2018, the value of customer contracts allocated to performance obligations not yet satisfied, including $2.44 billion of total deferred revenue, was approximately $3.2 billion. So what they're saying here is, hey, we have $3.2 billion out there that we're going to be recognizing, right? Here they say 60% is going to be recognized in the next 12 months. Only $2.44 billion of that is in deferred revenue. So in other words, there's revenue out there, you know, $0.8 billion roughly, that has not been collected, or has not been, you know, collected in part of deferred revenue, but is going to be recognized over the next, you know, few years, 60% in the next 12 months. And again, this is a, you know, Big Four audited, large accelerated filer, a Red Hat example and how they fulfill these requirements. So let's talk about the next couple categories here, and that is significant judgments. The only requirements here for non-public entities are the very first one, methods used to recognize revenue for performance obligations satisfied over time. And so that means your input or output methods, and then what type of input or output method. And then the other requirement for non-public companies is the second to the last bullet point that's in the significant judgments box, and that is assess whether any variable consideration is constrained. So you basically have to disclose, hey, we didn't recognize a certain amount of variable consideration because we didn't feel that it was probable that we would not have a significant reversal. That's what the variable consideration constraint is. So let's talk about these for both public and private companies. I kind of break them down by different steps. So step 5 of the revenue process is, you know, are you going to recognize revenue over time or a point in time? And if you're going to recognize over time, how are you going to measure that progress towards completion? And if it's a point in time, how are you going to determine with control transfers? And then the other kind of categories of significant judgments, I say, are steps 3 and 4. So steps 3 and 4 in 606 is step 3 is to determine the transaction price, and step 4 is to allocate that transaction price. So I have to disclose the methods and inputs I use to, you know, determine what that transaction price is, and how am I going to allocate it, and how am I going to allocate, or excuse me, estimate variable consideration, and is any of that constrained? Am I going to have to use judgments in estimating my returns and allowances and that kind of thing? And then again, the only two parts that are required for non-public entities are the methods used to recognize revenue over time and whether any variable consideration is constrained. So again, let's go through an example here. The division recognizes revenue based on the units of track replaced. So this is a railroad, the company's railway division lays railroad tracks. They lay railroad tracks. And that's how they recognize revenue, by the number of tracks that are laid down. And so that's one of the requirements for a public, private entity. And if I was a public entity, I would have to go on and say, the division believes that this output method, why I believe this output method is appropriate. The units replaced in relation to total units is to be replaced is the best measure, yada, yada. And additionally, this method appropriately depicts the division's performance of all work in process as control is transferred. So they have to elaborate on not just what method I used to measure my performance obligation that's being recognized over time, but why is it an appropriate measure? So let's talk a little bit about the cost to obtain or fulfill a contract. For public companies, they're required to disclose everything you see here, and only recommended for non-public companies if they feel they need to disclose this in order to meet the overall reporting objective. So you're required to present your judgments made to determine the cost to obtain or fulfill contract, the judgments that are used in determining the amortization method, and the closing balances of assets that are related to the cost of obtaining or fulfilling a contract. So let's look at another public company here, and this is Red Hat again. And as you can kind of see here, in the deferred selling cost, they have deferred commissions, and I've highlighted this here because it says that in February 28, 2018, they had to make an adjustment to reflect the impact of 606. Because 606, as I mentioned previously, now requires you to disclose commissions and capitalize them. So they had to capitalize commissions they previously had not capitalized. And so this is how they met the reporting requirements. And then they go on to say, here's how we amortize these commissions, and here's how much amortization expense was recognized in the period, and that there was no impairment, that kind of thing. Lastly, the practical expedients. If you're a public entity, you are required to disclose all the practical expedients that you used. If you're a non-public entity, you are recommended to. It would be helpful perhaps to a user, but not required. So what are all the potential practical expedients? There's significant financing, if a practical expedient if your contract period is less than a year. Same thing with cost to obtain a contract. Same thing with remaining POs, the green box underneath in the second column. Some other ones that are notable, the portfolio approach, the orange box on the right-hand side, and the as invoice practical expedient. But here's the list that I have compiled of all the potential practical expedients that you might need to disclose. And now I kind of want to finish up the last couple of minutes here with annual versus interim disclosure requirements. So we've gone through all these categories. All these categories are the categories that were presented in the brochure and that we've gone through. These are required for annual disclosures and the year after adoption, the interim disclosures in the year after adoption. And the reason I say the year after adoption is in the first year of adoption for most public companies, they're going to be adopting in Q1. And so you have to present the full annual disclosures in Q1 because you've adopted a new standard. You can't lean on the 10K, the prior 10K as being available to the readers. And so in the year after adoption, the interim disclosure requirements are significantly less. You can see the only categories that you have to meet are the disaggregation revenue, the contract balances, and the remaining performance obligations. Lastly, I want to talk a little bit about, activity level controls. The biggest one here I would say is the reliability of the reports that are used, and having someone review the completeness of the disclosures and review not just quantitatively but also significant judgments and estimates. And with that, let's go ahead and do our last poll question. And the last poll question is what do you believe will be the hardest disclosure requirement to implement? And again, I know that will probably be dependent upon whether you're a public entity or a private entity, but it can vary. And I would expect to see a pretty good mix. And I think that I'm seeing actually a really good mix here. The highest percentage I'm seeing is 25% for significant judgment. So it's pretty evenly spread out. So I think we're all kind of saying that, hey, we feel like these disclosure requirements, are going to be hard for some entities, not so hard for others. Looks like significant judgments has kind of taken a lead here a little bit. It's at 30%. But with that, I'm all out of time, and I want to thank everyone for being part of this presentation. And again, I really appreciate it. And if you have any questions whatsoever, feel free to email me. My email address is on the screen. And I'd be happy to answer questions or talk with you about how we can help you, implement this new standard. Again, feel free to ask me any questions, and thank you very much for coming.